This is another strategy when you hit another level. But right now, even me, when I was 19 buying my deals, I was able to save me a ton of money in taxes. And I don't think I've paid taxes in the last 15 years. So today's topic is how to avoid taxes legally. If you were watching on IG, you would have saw that today I had a client and I reviewed his taxes. He paid in $83,000 in income tax. And after he had his taxes prepared by someone else, he owed an additional $20,000 in income tax. That's $103,000 in income tax. That was over 25% of what he made. And to me, that's sick. That you work and you have to give away over 25% in taxes. Now, everyone says, hey, the rich should pay taxes and so that. And I agree, we should all pay our share. But to think that almost like 1/3 he's paying in taxes. For every hour he works, 20 minutes is worked not for his family, not for his retirement, but to pay taxes. So today I want to go over, here are some suggestions of how I legally and how many real estate investors legally avoid taxes. So I'm going to go to the board and we'll take it from there. So I used to bring in money through my W-2. So on your 1040, this is your 1040, right? And this is how you pay your taxes at the end of the year. And on your 1040, you have what most people have is their W-2 income. Then you have your interest income. You have your dividends. Then you can have your stocks. On top of that, you have your rental income. So it's probably really small to read. So on YouTube, you'll be able to see it a lot better. It's a lot larger. But I'm going to write it a little bit bigger. So right now, what I want to focus on, though, is just two types of income. W-2 income and then rental income. So in the tax code, there's something that's really special about rental property and real estate investing. Is with rental income right here, it's a separate sheet. It's your Schedule E on your taxes. So what happens is the money you make here will go onto this line item of your 1040, and your W-2 income will go on this line item. And they're going to take this money plus this money, you get a total, and this total you're going to pay tax on it. Okay? Now, let's just say you had rental income, but the total was not a positive number, it was a negative number. This negative number would go and reduce your W-2 income, so actually you would pay lower taxes. So you're going to say, well, if I have a negative income, I lost money in rental property. So how is that helping me make more money if I just lost money on my rental property? Well, the great thing about real estate is that there's so many tax benefits by being an investor. So you can actually make money, but on your taxes, it looks like you lost money. So you have your rental income, right? And then you have your expenses. So income minus expenses, let's just say you are positive, right? You're positive. But you have this thing in rental income, it's called depreciation. So this depreciation basically says that the building that you own went down in value. It's worth less because it's older. Now in reality, your property didn't depreciate. Your property actually went up in value. But for tax purposes, you're allowed to depreciate the property because it's now older. So now you're depreciating the property. This is a negative number. This is a negative number on paper, but in reality, you didn't lose anything. This is a paper loss, and it can actually show you as a loss overall, a negative number overall. So you take this negative number, where you actually didn't lose money, you actually made money. This now negative number counts against your W-2 income, which lowers your taxes. So a lot of wealthy people, they will end up investing in real estate not even to make money. They'll just do it to save on their taxes. So they'll just start buying lots of real estate to save money on their taxes. So sometimes you'll see these deals, and I would see these deals. I'm like, man, I can do the smaller deal and make 10% on my money, but this larger deal is only 5%. Why would anybody do that? I'm thinking these rich people, they have to be smart because they're rich. Why would they do a 5% deal? I later realized they're doing these 5% deals because it's one, they need to buy big deals to get big tax write-offs. Two, because of how large their tax write-off is, that real estate deal is actually making them more than 5% when they account for the taxes they're saving. So in reality, they end up making a lot more money when they add back for taxes. This is another strategy when you hit another level. But right now, even me, when I was 19 buying my deals, I was able to save me a ton of money in taxes. And I don't think I've paid taxes in the last 15 years, meaning income tax. Well, I hope that gives you an idea about how a small idea of how the tax system works and the overall strategy as a real estate investor. Now, anyone that has any questions regarding this, please send me messages. And if you have any questions regarding credit and how everyone's credit score just got dropped around 25, 30 points, also feel free to send questions regarding that. All right, so 1% says personal finance is only a small percent of self-development though. I agree, it is only a small percent, right? I think there's 5 pillars to your life. Spiritually, physically, mentally, emotionally, financially, okay? If any of these are off, you're gonna feel like something is missing in your life, okay? The thing is this, what I found, if you have your finances in order, you have a lot of time to work on those other items. Number one reason for divorce, financial problems in a household. Your relationships are gonna be a lot better if you have your finances in order. So just keep that in mind that yes, finances aren't everything, but they are very important. How much can you depreciate of the building value every year? So in a residential, 4 units or less, you can do it over 27 and a half years. So it's the amount, the property divided by 27.5. In a commercial deal, it's divided by 40. But you can go into a more aggressive depreciation model if you get an engineer to do a cost segregation model on your building. So sometimes you can depreciate 30% of the building year one. So again, you put in $200,000 into a $1 million deal. You put $200,000 of your own money, but you could hypothetically depreciate the property $330,000 more than the amount of money you put in. So if you have a high tax bill, you have a $600,000 tax bill, you can write off $330,000 of your income, of your earned income, and get a huge tax savings. Roughly, you would save about $110,000 on that move. So yeah, you spent $200, but you already saved $110 just on your taxes. You made 55% return just on your taxes. It's really great. All right, so you have a company that provides property loans? If so, what are the general requirements to obtain? So most of the loans we're doing now are like commercial style loans or hard money loans. So you're just gonna flip a property. We do not do like FHA loans or standard Fannie or Freddie loans yet. We're in the process of offering that as well. So it depends on what your needs are. You're going to have a, owner-occupied property, a long-term rental, or, a flip. And then there are different loans for each. Your loan is just a tool, and you need to make sure you're using the right tool for your objective on the property. Don't use debt, bro. Everyone thinks debt is an asset. It isn't. Debt is debt. Even property loans. That is incorrect. Most wealthy people in the world use debt, and debt is a tool. So you use debt to help you grow. You can use debt the wrong way, or you can use the right way. It's kind of like people used to say fat is bad. Fat is not bad. Avocados are very good for you. Avocado is almost all fat, but that is good fat. there is good fat and bad fat. There is good debt and bad debt. So debt is helpful if used properly. So Freeway says, sounds illegal. It's actually not illegal. It's part of the tax code, and it's used by all levels of investors and mostly used by the super rich because they're trying to do everything possible. What is the age of the building? The age of the building actually doesn't matter. You know, you can buy a brand new building and depreciate 33% year one, you know, if you have the proper cost segregation model. Dr. G says those offshore accounts. No, you do not need to use any offshore accounts for this strategy. All right. Emilio CPA, what do you think about investing into opportunity tax zones? So Emilio CPA, if you think anything I said was wrong, please blast me in the comment section that I'm wrong. But I know I'm not wrong because I'm also an accountant. So I know these rules. So what Emilio CPA is talking about now, he says, tell me about opportunity tax zones. So there was this great thing that came out, and it's talking about opportunity zones. Opportunity zones are areas usually that are lower income, that need assistance to grow the economy in that area, and there's major tax credits for that. In an opportunity zone, if you open up an opportunity fund and you purchase a property or a business in that zone, when you sell it in 10 years, the business or the building, you pay no tax on the gain. Let me repeat that. You can buy a business or even start a brand new business in an opportunity zone. Grow that business to say be worth $10 million. When you sell the business in 10 years, you would pay no tax on that business. So opportunity zones for investment properties. This one takes a little bit more detail. If you're buying a property in an opportunity zone, and it must be purchased within an opportunity fund, not that hard to do if you have the proper accountant to set it up. You buy the building for $1 million. The rule is that you must spend an additional $1 million on that property within 30 months of purchase. Okay? 30 months of purchase, you must spend 100% of the cost of the property. The easiest way to do it normally is when you're building a brand new building from scratch. I did run some scenarios where I found properties where I could just buy the property, do upgrades on 80% of the property, and then just spend the rest of the money on the extra land to build an additional building, where then I would meet the requirements and the return on investment was a lot better. So I think opportunity zones are good, but never make decisions just on tax reasons. You want to make sure that you're buying a good asset, and the savings in tax is just an extra. The most important thing is buying a good property at a good price. Never overpay just because you feel like you need to get your money at work. Never buy a property just because you're trying to save money on taxes. Because if you buy the wrong property, it can cause you so much headache that it will drain your energy and your time from investing in anything else. So I bought a property in that same scenario back in 2008. And that property for 3 years drained my time, drained my energy, took my focus away from other things that would make me more money. Did I end up making money on that property? Yes. Could I have made more money elsewhere? Yes. So what I would say is, be focused and more on making a better return than to save money on taxes. Okay?